Hello and welcome back to this month's edition of AWM News Update with our new look and feel. We take the opportunity to thank our viewers for more than 50,000 views in our last 3 episodes. We have some interesting stories for you this month. Zoa?
Yes, fairly interesting actually. I'll be doing a small deep dive into pension schemes and you're taking us through China on In the Markets.
Yes, there have been a lot of developments in that space. Also, M&A activity has been on the rise and we will be covering that in Around the Globe. And finally, in the research section, we will be looking at the newest EFAMA study that looks at investment fund ownership in Europe.
Let's start with In the Markets.
China's done a lot in recent years to expand their market to foreign investors. Recently, the government announced that it would be merging the QFII and RQFII schemes in the hope of solving seed capital issues that foreign managers face. Overall, we have seen China's market really go from strength to strength in recent years. Assets under management grew from $1.1 trillion in 2012 to $5.5 trillion in 2017. A massive 38% CAGR, and we believe that market will continue to grow and is likely to reach $11.1 trillion by 2025. The MSCI has also announced that it will quadruple its weighting of Chinese A-shares available to trade its emerging markets index by August this year. This will massively open up the market and increase China's A-share weighting to 3.4%. These shares will also be included in the Bloomberg Barclays Aggregate Index, and they are expected to make up 6% of the total index. What was fairly interesting to see was the growth in Stock Connect accounts following the announcement of the inclusion. 5,600 new accounts were opened following the announcement, and the total northbound portfolio grew by $84 billion. Let's see what's been happening elsewhere around the globe.
Some interesting points there, Dariush, on China's possibilities for asset managers. I mean, we've long seen that emerging markets will be the growth engine of AUM in the coming years, and China is definitely a big player in that growth.
Absolutely, Zoa. We have seen a number of moves from foreign asset managers into China, and I think this trend is going to carry on because now foreign asset managers are able to hold 100% of their subsidiaries in China, which was not the case before.
Right.
However, what I'm troubled with is really the case if the trade war between US and China intensifies. What will be the opportunities and challenges facing such asset managers trying to enter China? That's really anyone's guess.
Well, speaking of growth prospects, M&A in the fund industry saw strong growth in 2018. In fact, it hit an all-time high.
Announced deals rose from 207 in 2017 to 253, and it's estimated that disclosed value increased by 27.1% from 2017 to reach $27.1 billion. Zoa, we spoke about it during our report, AWM Revolution, Pressure on Profitability.
That's right.
And my analysis is that as we see pressures on fees, we will see that a number of asset managers will look into M&A in order to increase their efficiency as well as reach.
That's right. We've already seen some big movements in this space recently as well. Brookfield Asset Management acquired 62% of Oaktree. The book value of the deal was $4.7 billion. And in Europe, the Generali Group acquired a majority stake in the French investment manager Sycamore. With Generali's aim to be Europe's leading multi-asset boutique asset manager, the group seems to be making strong strides in that direction. John Siciliano, PwC's AWM strategy leader, joins us to discuss the future of M&A in the AWM space. John, thank you for joining us. Perhaps you can tell us a bit more about what we can expect from the AWM and M&A space in the coming years.
Thank you for having me on. It's always a pleasure to be back. Well, when you look at asset and wealth management M&A, there's no question that the expectation over the past several years has been that we would see increasing M&A activity broadly. In fact, we have not seen as much big M&A as would be expected Instead, we have seen what we view as selective lift-out or small acquisition M&A, as people tend to be looking at ways to build out their product set. And they're looking to build out their product set in an environment where shelf space is increasingly less available and fee pressures are increasingly greater. And as a result, large M&A doesn't necessarily solve these problems, because like managers aren't going to be as interested in each other as they're going to be interested in diversifying their product set away from that which they have towards more alpha-focused products.
And in the US, with the recent Oaktree deal, it seems that alternative firms are becoming quite interesting for the large traditional managers. Do we expect to see more traditional managers move into this space through M&A?
We do think as a firm that you are going to see more M&A in the alternative space, either with traditionals who are seeking to deliver other forms of alpha in order to complement their more traditional strategies which are under pressure. And we also think there'll be M&A in the alternative space as alternatives firms seek to mimic the Oaktree transaction with the objective of building scale. All of this means that what we are going to see is very consistent with our Asset and Wealth Management Revolution report of last October, which pointed out that by 2025, we fully expect alternatives to range between 15 and 25% of institutional portfolios, depending upon where you are looking around the globe.
Thanks, John. Well, to me, I think it really makes sense for asset managers to acquire the expertise in a specific asset class rather than to completely build it up internally.
Well, I mean that deal value has been rising. However, I'm definitely sure that there will be some interesting M&A deals for asset managers in this space. But let's see what's been going on in actives.
There's often talk in the industry of actives outperformance over passive. Scope Analysis, a German research and rating firm, released a study analyzing 2,000 UCITS active equity funds in Germany. The study showed that the share of these funds that actually outperformed their benchmark dropped by over half, from 53% in 2017 to 24% in 2018.
2017 was an excellent year though, so it does make sense that there was a relatively high outperformance ratio that year. However, the study does tend to bring credence to the idea that active will struggle to outperform passive over the long term.
Speaking of passives, let's see what's been happening in that space.
On a similar note, JP Morgan recently stated that the speed of the shift from active to passive funds could double. The investment bank notes that passives currently account for 15% of the European market. However, due to greater transparency and competition, the shift is definitely set to accelerate.
One point from the report that I found particularly interesting was that the shift could concentrate assets in a few large funds, which could mean we see a rise in systemic risk. But let's see what's been happening in alternatives. So this month, we saw the UK government propose regulations that would make it easier for defined contribution pension schemes to invest in alternative asset classes. These investments could potentially reap higher rewards, such as the growing interest in housing, green energy, and sustainable development among investors. According to a recent report by Willis Towers Watson, in the world's 7 largest pension markets, 2018 saw a remarkable development. DC assets overtook DB assets for the first time. Although the majority seems to stem from the US, which still accounts for over 50% of P7 assets. This follows the global trend of seeing DC assets growing faster than DB in recent years. According to the report, over the last 10 years, DC assets saw a growth of 8.9%, while DB only saw a 4.6% growth. IPE also conducted a survey of European pension funds, where they found that 27.9% of respondents said that the asset class they were most interested in for the coming year is alternative risk premia, while an even larger 57.4% of respondents said ESG impact investing is at the top of their priorities. This is noteworthy, as the Willis Towers Watson reports outlines that there are significant opportunities being missed in the areas of sustainability, ESG, stewardship, and long horizon investing. Last year also saw a reform to the German pension system, which allows for investment in new asset classes and for asset managers to become more involved in the pension market. It will definitely be interesting to see what happens to the pension markets in the coming years, but for now, let's take a look at the research reports.
EFAMA recently released a research report entitled Ownership of Investment Funds in Europe. The report drills down into the evolution of holdings of financial assets and investment funds between European investors. The report highlights that households were the largest holders of financial assets in Europe.
While overall they hold the majority of financial assets, insurers and pension funds remain the largest holders of European investment funds in 2017. It talks about the state of penetration rates of investment funds and other retail investment products too.
That's it for this month though. Remember to keep an eye out for our next release.
If you don't want to miss anything, why not hit that subscribe button and you'll get notified every time we release a new video. And while you're at it, if you're enjoying these videos, let us know in the comment section below or by hitting the like button. Thank you, and we'll see you next time.